like everything in today's sort of partisan atmosphere, there are those that say, why do these guys and gals deserve a bailout when so many other people don't get a bailout? And it's basically, socializing capitalism when capitalists are always disparaging socialism. But you think that it was necessary because it just needed to be done? Or
the single greatest priority of the federal government should be to protect the safety and soundness of the banking system.
Was that really what it was doing in this case?
Which is the beating heart of our economy. It's the beating heart of every household and every business. There was a real concern about a contagion spreading to the broader banking system. And I thought the administration did act correctly and act aggressively to prevent the contagion from destabilizing.
Whose deposits are getting guaranteed here? They're people that, let's say, they can afford to lose it. And we talked about people not getting payroll. But in general, these are, startups. And, you can even tie it back to investment banks, venture capitalists. These are people that are doing pretty well in society. And they're taking risks. They're going to benefit if they hit it big. Shouldn't they suffer the consequences when they...
Look, if the damage had been contained to Silicon Valley Bank, then there would have been an argument against intervention. But once it became evident that the risk was spreading to the broader banking system, we have an obligation to intervene, and that's the regulatory framework that we crafted in 2008. It's to account for
what do you think of
risk.
this? Look at this screen for a second. First Republic Bank down 20% this morning. You can actually just see the nerves. PacWest down 10%. Western Alliance down 8%. The question is actually, did it work? Talk about contagion. Meaning, are we going to see shotgun weddings this weekend and other kind of capital, investments made because people are worried about this very thing?
Look, I'm convinced that there would have been cascading bank failures in the absence of intervention from the government.
But do you think there's going to be more? Are we talking about now more intervention? Meaning that was a first step in a long sort of number of steps of intervention.
Look, it might take time for the banking system to stabilize, but that's an argument for the Federal Reserve, for example, to proceed with caution. As you know, the Federal Reserve has a dual mandate of price stability and maximum employment. A case could be made that we should expand the mandate of the Federal Reserve to include financial stability.
Right.
When it comes to raising higher interest rates, I think the Federal Reserve has done too much too fast, and it's destabilized the banking system, and there's an argument for slowing down.
So we did Dodd-Frank. We maybe diluted it to some extent. Senator Warren has been making that case. Do you think there could have been regulations that would have prevented what happened at SVB?
Look, hard to know for sure, but if SVB had been subject to enhanced prudential standards and stress testing, then there would have been a greater likelihood of flagging the concerns about the failure of interest rate risk management. So I would argue yes. And if we're going to provide broader deposit insurance to regional banks, then it's only fair to subject those banks to a higher standard of regulation.
Mm-hmm. So then the question, though, is do you insure all deposits? Is that the answer? We were talking about do you just raise it on individuals to a certain number? I was throwing out the idea that you could create effectively an insurance program for accounts that could be sort of ring-fenced as payroll accounts. So if you're a corporation and you have money in simply for payroll, now I know money's fungible, that you insure those accounts, but maybe you don't insure the entirety of everything, because once you insure everything, does it change the sort of moral hazard question?
Look, it's an issue that we have to explore, but I kind of disagree with the premise of the question. I actually felt like the system worked, that the regulators did have the flexibility and authority they needed to respond rapidly to the situation. I think we insured deposits up to $250,000, but the systemic risk exception allows us to broaden that to prevent contagion.
But right now it's implicit. It's not explicit. So if we actually have to test this, that's what I worry about is waking up one morning, we have another bank that has a true run. And what happens then? Does the government backstop those deposits? And then do we have another run? That's the kind of, I think, question mark that people have, which I think fairly raises a question. If you have more than $250,000 in a bank account on an individual basis, or you are a business, do you say to yourself, I need to move some of that money?
I think the government has made it clear that we're willing to do whatever is necessary to prevent contagion. And we've established a precedent for ensuring all the depositors at regional banks. We've effectively expanded the realm of too big to fail to include the regional banking system. So that sends a powerful message to the public.
I mean, Moody's was aware of what was going on, as we know. There were a lot of people on Twitter that seemed to be aware of what was happening, yet the San Francisco Fed did not seem to be aware of the problem. Whose fault was that?
There are layers and layers of failure. There's a failure of interest rate risk management on the part of the bank executives, who should be held accountable. But there's also a
Should
failure
they be held
of
accountable?
supervision.
Clawbacks?
There should be clawbacks. But there was also a failure of supervision, a failure of regulation, or arguably a failure at the level of monetary policy. So all those variables contributed to the collapse of Silicon Valley Bank. But also it was a unique circumstance. I mean, Silicon Valley Bank, more than 90% of their deposits were uninsured, and those deposits were heavily concentrated in a single industry that was highly sensitive to interest rate changes.
Yeah, but
that's an anomaly.